Hi there, it's Friday the 22nd of February 2019. I'm Steve Towers. Welcome to ITB, coming to you today from Tokyo. Let's get started. Well, it didn't take long. Just a few days after the OECD's consultation document was released, the folks with vested interests started public campaigning for their preferred options. For the US government, that means the Marketing Intangibles proposal under Pillar 1. A US Treasury official predicted that a consensus within the inclusive framework would form for that proposal, probably with a more formulaic version of the residual profit split method. He criticised the other two proposals under Pillar 1, the user participation proposal and the significant economic presence proposal, on the basis that they are focused only on cross-border digital companies, which effectively means a ring-fenced approach, which the US strongly opposes. The US government's support for the Marketing Intangibles proposal has alarmed some US non-digital consumer products companies. An executive with one of those companies this week defended the arm's length principle and said that it should remain the bedrock of international taxation. In contrast, the German government doesn't like any of the three proposals in Pillar 1. Its preference is for the Pillar 2 proposal, the Global Anti-Base Erosion proposal, to be the only proposal which is implemented. A German government official has stated that the two pillars are directed at different issues. That's correct. Pillar 1 is directed at expanding source countries' taxing rights, which is an issue that fell outside the scope of the BEPS project. Again, correct. Whereas Pillar 2 is designed to address some tax avoidance weaknesses which were left over from the BEPS project. That's also correct. She then suggested that the tax avoidance weaknesses left over from the BEPS project should be addressed first, which basically means let's consider Pillar 2 now and defer the consideration of Pillar 1. But a US Treasury official said that that horse has already bolted. That's why there are two pillars. Because while some smaller set of countries would be happy with just doing something under Pillar 2, a lot of countries are interested in not just ensuring that a multinational's income is subject to a minimum level of tax, but also ensuring that some of that income is subject to tax in their country. And that has really been the theme of all of the digital work for the last year or two. One of the key aspects of the Marketing Intangibles proposal is that it will apply to create a nexus in a market jurisdiction only if the positive attitude in the minds of customers is created by and the customer information and data is acquired through the active intervention of the firm in the market. It is thus different from favourable demand conditions in the market jurisdiction that exist independent of the actions of the firm. Well, this week a number of US Treasury officials have suggested that B2B transactions might be excluded from the scope of the Marketing Intangibles proposal. The reasoning for that suggestion is not that you don't find examples of active intervention of the firm in the market in B2B situations. Instead, it's just that the political demand in the market jurisdictions is to deal with B2C situations. I'll be interested to see whether that scope limitation finds consensus in the inclusive framework. And I will be equally interested to see whether the existing scope limitation in that passage from the consultation document finds consensus. For example, will we see a number of developing countries, and most notably China, insist that favourable demand conditions per se create a nexus in the market jurisdiction? That is a potential major friction point. The OECD has extended the deadline for public comments on the consultation document. The new deadline is the 6th of March. The public consultation meeting in Paris remains scheduled for the 13th and 14th of March. The EU's proposed digital services tax is undergoing a revamp. Firstly, the name has changed. It's now the Digital Advertising Tax. And secondly, reflecting the name change, the proposed scope has been limited to revenue from online advertising. The rate is still 3% and the threshold is the same. Global revenue of €750 million and EU revenue of €50 million. ECOFIN will consider the proposed digital advertising tax at its meeting on the 12th of March. The fate of Spain's proposed digital services tax is currently unclear. As I'm sure you know, the Spanish Parliament voted against the government's 2019 budget bill, which included the digital services tax, and a general election will be held on the 28th of April. There's every chance that there will be a new Spanish government. But in New Zealand, it looks like the government will introduce a digital services tax as an interim measure pending the global adoption of a long-term solution for digital taxation. The government has announced that it will issue a consultation document on this topic, likely by May. For a copy of the government's announcement, please go to our website. In Germany, it's been reported that some tax auditors are taking the position that outbound payments for online advertising services are royalties and are therefore subject to German royalty withholding tax. The apparent theory supporting this move is that online advertising services constitute the provision of know-how, or, in the words of the definition of royalties in the OECD Model Treaty, the provision of information concerning industrial, commercial, or scientific experience. German tax advisors who have expressed public views on this theory in the last week or so all say that this view is wrong. The theory has been supported by a recent paper written by the head of the Munich Tax Audit Department and published in a German tax journal. The good news is that the Federal Ministry of Finance has been quick to react. The technical issue will be studied and an official position will be announced, but not before this coming summer. In the meantime, folks will have to consider the consequences of the tax auditor's view. Here's a quick list. Under domestic law, the withholding tax rate is 15.825%. If the withholding tax needs to be grossed up under the contract, the withholding tax rate is 18.8%. If German advertisers don't withhold the tax auditors will likely require the advertisers to pay the tax. Relief under double tax treaties is possible, either a lower rate or exemption, depending on the treaty. However, Germany has domestic anti-treaty shopping rules, and so treaty relief is not automatic. Also, to have the German advertiser apply the treaty rate at the point of payment would require a withholding tax exemption certificate issued by the tax authorities. Relief under the EU Interest and Royalties Directive might also be possible if the recipient is established in the EU. The German advertiser might have its deductions limited. For trade tax purposes, there is generally a cap on deductions for royalties. And finally, probably the biggest issue, retrospective application of this view to prior years. Of course, some other countries already impose withholding taxes on outbound payments for online advertising services, but they have generally done so by introducing a new tax, not by merely changing an interpretation. An example is Turkey, which introduced such a withholding tax effective the 1st of January 2019. The government has now released guidance on this new tax. Withholding tax of 15% will apply both to outbound payments for online advertising services and payments to resident individuals who intermediate the provision of such services. Unfortunately, the guidance does not address the issue of treaty relief. In India, the government has issued another notification in regard to the so-called angel tax provision, which has proved to be a major obstacle for startups in India. This is the government's third attempt to get the notification right. The two previous notifications have been superseded. Commentators have given this new notification mixed reviews. On the one hand, they welcome the increased limits for a company to qualify as a startup. However, they don't like the restrictions on investments which a startup is permitted to make. For a copy of this new notification, please go to our website. And in Singapore, the government has presented its 2019 budget. The only item to catch my eye is that a number of expiring tax incentives have been extended for several years. In particular, income tax incentives in regard to Singapore-listed REITs, income tax incentives in regard to funds which are managed by Singapore-based fund managers, and tax depreciation for the acquisition of IP. I have two cases on VAT from the European Court of Justice. The first case is called Nestrade, which is a Swiss company. The case originated in Spain. Nestrade applied for a refund of Spanish VAT it had incurred on a number of invoices issued by a Spanish supplier. Those invoices stated incorrect information in regard to Nestrade's Swiss VAT number. The Spanish tax authorities gave Nestrade 10 working days in which to supply the corrected invoices. It failed to do so. Nestrade obtained the corrected invoices from the supplier several weeks later, but strangely, did not forward them to the tax authorities. Then, 3 months later, in April, the Spanish tax authorities reached a decision to refuse Nestrade's VAT refund request, and that decision became final a further month later in May. It wasn't until August, a further 3 months later, that Nestrade supplied the corrected invoices to the Spanish tax authorities. The court held that EU law does not prevent Spain from imposing a time limit on the possibility of rectifying incorrect invoices for the purpose of claiming a VAT refund. However, in applying such a time limit, the Spanish law must comply with two principles. The first principle is called the principle of equivalence. This requires that persons asserting rights conferred by EU law must not be treated less favourably than those asserting rights of a purely domestic nature. And the second principle is called the principle of effectiveness. This requires that the Spanish law does not, in practice, render impossible or excessively difficult the exercise of the right granted by EU law, in this case, the right to refund of the VAT. The court concluded that there was no evidence before it which indicates that either principle was breached. In particular, in regard to the second principle, the court said this: it should be noted that the order for reference from the Spanish court does not indicate that Nestrade had notified the Spanish tax authorities of the fact that it was not in possession of correct invoices on the date of that authority's request. It is moreover clear from that order that Nestrade did not provide those invoices to the tax authorities in the period of almost 3 months, which elapsed between the date on which it obtained them and the date on which the decision refusing the refund of VAT was adopted. Nestrade also did not contest the latter decision before it became final, even though it could have brought an appeal against that decision within reasonable time limits. For a copy of this decision, please go to our website. The second VAT case from the European Court of Justice is called Human Operator. This case originated in Hungary. Effective the 1st of January 2015, Hungary changed its domestic law to introduce a reverse charge mechanism. Human Operator, a Hungarian company, got caught out by this law change. In the early months of 2015, Human Operator acquired services from a number of Hungarian suppliers. Those suppliers issued invoices which charged VAT. Human Operator paid those invoices, including the VAT, and then claimed an input tax credit for the VAT it had paid. The Hungarian tax authorities said no. In accordance with the law change, those acquisitions of services were subject to reverse charge. This meant that Human Operator owed VAT output tax to the tax authorities on the notional supply to itself. But the introduction of the reverse charge mechanism in Hungary was a derogation from the normal EU rules. That meant that it needed to be authorised by an EU Council implementing decision, which it was. But that implementing decision was notified to the Hungarian government on the 11th of December 2015. The implementing decision is silent as to its effective date, but it does say that the authorisation will expire on the 31st of December 2017. So you can see the issue in the case. Did the implementing decision have retrospective effect, authorising the introduction of the reverse charge mechanism in Hungary almost 12 months earlier on the 1st of January 2015? The Hungarian government made a number of arguments. Firstly, it said that in its proposal for derogation, it told the European Commission that it has already started to apply the derogation without waiting for the implementing decision to be adopted. Secondly, the implementing decision set the expiry date at the 31st of December 2017, and the European Commission had acknowledged that Hungary's request for a 3-year term would be agreed to. So you can see that the Hungarian government had some reasonable grounds to believe that the implementing decision would be effective for 3 years, from the 1st of January 2015 to the 31st of December 2017. But the court said no for 2 related reasons. Firstly, as the implementing decision does not indicate an effective date, it takes effect by notification to the Hungarian government, which is the 11th of December 2015. And secondly, the principle of legal certainty requires that it cannot take effect before that notification. So that meant that the reverse charge mechanism could not be validly applied in Hungary before the 11th of December 2015, and thus Human Operator was not liable for VAT output tax. For a copy of this decision, please go to our website. In Ireland, the government has launched a public consultation in regard to proposed amendments to the country's transfer pricing rules. Public comments are requested by the 2nd of April. Yes, someone in the government is presumably attuned to April Fool's Day. The specific issues on which the government is seeking feedback are these: incorporation of the OECD's 2017 transfer pricing guidelines into the Irish tax legislation, removal of the existing grandfathering rule for arrangements in place since before the 1st of July 2010, whether the transfer pricing rules should apply to SMEs, and whether the transfer pricing rules should apply to non-trading and capital transactions, transfer pricing documentation, and introduction of the authorized OECD approach to the attribution of profits to Irish branches. For a copy of the consultation document, please go to our website. Poland has been given approval by the EU Council to introduce a VAT split payment system in regard to 152 types of goods and services. A VAT split payment system is a protection against VAT fraud. It requires the purchaser to make 2 payments, one to the supplier for the net amount of the invoice, and the other to a special bank account which is monitored by the tax authorities for the VAT part of the invoice. Such a system is contrary to the EU's VAT rules, and thus it requires the EU Council to authorise it. The Council implementing decision relevantly says this: Poland is authorised to introduce a special statement that VAT shall be paid to the separate and blocked VAT bank account of the supplier opened in Poland on invoices issued in relation to supplies between taxable persons of goods and services listed in the annex to this decision, where payments for supplies are made by electronic bank transfers. This decision shall apply from the 1st of March 2019 to the 28th of February 2022. For a copy of the implementing decision, please go to our website. In the UK, the Court of Appeal has decided a case in regard to whether the appointment of a receiver to a company, Exco, causes Exco to cease to be in a group relationship with other companies in its corporate group, with the consequence that Exco can no longer participate in group relief, the transfer of tax losses, with those other companies. The court concluded, yes, that is the effect of the appointment of a receiver. For a copy of the decision, please go to our website. In Kenya, the Court of Appeal has decided a case in regard to the time at which a liability for withholding tax arises. Based on deeming provisions in the legislation, the court held that even though there has been no actual payment, a liability for withholding tax arises at the time the accrued payment is recorded in the payer's accounting records. For a copy of this decision, please go to our website. In South Africa, the government has presented its 2019 budget. Here are the items that caught my eye. In the CFC rules, the tax rate for the high tax exemption is proposed to be reduced. Strangely, the government proposes to reduce the scope of the PE definition under domestic law. This will be done in order to align that definition with the definitions of PE in South Africa's treaties. South Africa has chosen not to expand those definitions pursuant to the MLI. Further anti-avoidance rules in regard to dividend stripping will be introduced, and in regard to the carbon tax, which takes effect from the 1st of June 2019, the government proposes to release draft rules by next month. In Saudi Arabia, the government has published the final version of the transfer pricing bylaws, which cover both substantive TP issues and TP documentation. The bylaws are effective for reporting periods ending on or after the 31st of December 2018. You'll remember that the bylaws were released in draft form for public comment in December. Well, there are no major differences between the draft and final versions. For a copy of the final bylaws, please go to our website. In Brazil, the tax authorities have issued a normative instruction which makes changes to the country's transfer pricing rules, effective for the 2019 and subsequent years. The changes concern the mechanics of calculations under Brazil's existing idiosyncratic transfer pricing methods. The changes do not concern any possible alignment with OECD methodologies. For a copy of the normative instruction, please go to our website. And now for this week's treaty developments. We've had one treaty signed and one treaty enter into force. I have two articles for you this week. The first article is called How Did McDonald's Get Off the EU State Aid Hook? It's written by Barry Larking and it's published in Tax Analyst's Worldwide Tax Daily. Yes, this is yet another article on the McDonald's state aid case. However, this article does give a good description of the change in the European Commission's treaty analysis. From the initial decision in 2015 that the Luxembourg rulings breached the state aid rules, to the final decision in 2018 that they did not. You'll remember that the structure involves a Luxembourg company with a US branch, which derives income from European franchisees. The US branch has only a minor amount of activity. That minor amount of activity caused the US tax authorities, in the view of the European Commission, to conclude that the Luxembourg company did not carry on business in the US through a PE, and therefore the business profits article of the Luxembourg-US Treaty prevented any US tax on the branch income. In addition, although not part of this view, the US branch activities were not taxable in the US under US domestic law. In contrast, the Luxembourg tax authorities concluded that the Luxembourg company did carry on business in the US through a PE, and therefore the business profits article of the treaty did allow the US to tax the branch income. This difference in conclusion between the US tax authorities and the Luxembourg tax authorities then has an impact on Article 25(2) of the treaty. In Luxembourg, double taxation shall be eliminated as follows. A. Where a resident of Luxembourg derives income, which, in accordance with the provisions of this convention, may be taxed in the United States, Luxembourg shall exempt such income from tax. According to the author, the change in the Commission's view between the initial 2015 decision and the final 2018 decision concerns the highlighted words, which, in accordance with the provisions of this convention, may be taxed in the United States. The author writes this with a little elaboration from me. The OECD commentary references in both the initial and final decisions assume that the two treaty states take different views regarding the source state's right under the treaty to tax the income. The essential difference between the initial and final decisions appears to be whether those different views are caused by variations in their respective domestic laws, or alternatively by differences in their autonomous treaty interpretations. If the different views are caused by domestic laws, which is the reason referred to in the initial decision, for example, the US uses Article 3(2) to insert a domestic law meaning of business into Articles 5 and 7, and the source state thinks it cannot tax, the resident state is free to do so. This is why, in the initial decision, the Commission took the view that Luxembourg was not required to exempt the branch income. If the different views are caused by a disagreement that is not caused by domestic laws, which is the reason referred to in the final decision, that is, the US adopts an autonomous treaty interpretation that Luxco is not carrying on business in the US through a PE, the resident state should follow its own interpretation. This means it would have to exempt the income if, based on its own interpretation, it thinks the source country can tax. The second article is called VAT Trends in Europe, Digitalization and Real-Time Filing. It's written by Alexandra Ball and it's published in Tax Notes International. In this article, the author examines within the EU the push to digitalize VAT compliance and the shift towards real-time invoice submission. She starts by looking at the movement towards imposing an obligation to report transaction data on a regular basis using a standard audit file for tax. The author then looks at the next step, real-time transmission of data. She writes this: some countries have gone one step further and started requiring real-time transmission of transaction data. Spain was the first EU country to introduce the obligation, followed by Hungary. Shortly thereafter, Italy implemented an invoice clearance model that goes beyond real-time reporting of transaction data. In Italy, businesses cannot issue valid invoices unless the tax administration has approved them. Several other countries are considering similar solutions. Broadly, the EU is in the middle of a transition to real-time VAT controls. Well, that's the way it is this Friday, the 22nd of February 2019. I'm Steve Towers in Tokyo. Have a great weekend.